Hello everyone, and welcome back to Dr. Tao's Quant Lab. Over the last few lectures, we built the Kellner highway to write trends, and we mapped Bollinger Bands to catch breakouts. But today, we need to talk about gravity. We need to talk about mean reversion. To understand mean reversion, you have to realize that a moving average is not just a line on a chart. It represents the average transaction cost of everyone's trading that stock over that time period, and prices cannot stay discounted from their average cost forever. Why does price always snap back? Because the stock market is driven by pure supply, demand, and liquidity. Imagine a stock goes parabolic. The institutions who bought early are sitting on massive profits. What do? They lock in those gains by selling. At the exact same time, new buyers look at the inflated price and refuse to chase it. Buy orders drop, sell orders spike, and the price collapses back to the average. The reverse happens in a crash. If a stock drops 30% in a week, the sellers are trapped and they refuse to cut their losses. Meanwhile, the short sellers who bet against the stock have to buy it back to lock in their profits. That sudden short covering triggers massive buying demand, and we get a violent relief bounce. To mathematically measure how far the stock has deviated from that average cost, we use the bias indicator. It calculates the exact percentage difference between the current closing price and the moving average. When you open your trading app, you will see the standard institutional settings, a 6-day, 12-day, and 24-day line. Do not change this to 5, 10, and 20. The 6-day system provides a mathematical buffer that filters out weekend noise and gives us vastly cleaner signals. Now, how do we actually trade this? First, we only use this strategy on large cap US stocks with a market cap over $10 billion. We need the law of large numbers. If the stock qualifies, we watch for 3 strict mathematical thresholds. We start with the 6-day bias. For a large cap, an average daily move is about 1%. A rare relentless 6-day push gives us a baseline maximum deviation of 6%. But how do we find the thresholds for 12 days and 24 days? In quantitative finance, volatility scales with the square root of time. To find the 12-day thresholds, we double the time. So we multiply our 6% baseline by the square root of 2. That gives us 8.5%. To find the 24-day macro thresholds, we quadruple the time. So we multiply our 6% by the square root of square root of 4, which is 2. That gives us 12%. If you see a stock hits these 3 numbers, 6% for period 6, 8.5% for period 12, and 12% for 24, both can be positive or negative. A reversion is imminent. Why do we use these three lines? Because we want triple confluence. Now let's look at the app. Okay, so first off, let's look at an example for Nvidia. First off, you need to check that market cap greater than 10 billion. And for small capital, small capital can impact the price a lot for a small market cap company. So we will never look at any company less than 10 billion, right? And for the indicators, for bias, you just search for BIAS, then you can see this bias, then you click it. You can see that there's a chunk that just represents the bias. And we can see that from the settings, we can see that the periods are 6, 12, and 24 days respectively. And these three lines are basically blue, orange, and pink in my app. You can basically change the color if you want. And here I basically draw this horizontal lines for 6%, 8.5%, and 12% respectively. And also, if you want, you can draw the -6, 8, and -12 for clearly see this range. And here I boxed everything higher than the extreme value. For example, the pink one, right, should greater than 12% for extreme value. And you can see this day is right here and this day right here on May 14th. For the orange line, we need to look at this 8.5%. So we have this days here and this days here. And the last one will be this 6 days or bias 1 6 days line, and we compare it with 6%. So only one day right here is greater than 6%. So if you see that on any day, any two of these three greater than its extreme value, then we will then that is a significant signal for not buying, okay, for a positive part. Okay, so let's look at this chart of Nvidia on May 14th. So stock surges, and in the bottom pane, again, look at the blue boxes. The 6-day, 12-day, and 24-day lines all reach their extreme positive thresholds at the exact same time. And again, this is a stop buying signal. So this mathematically proves the stock is exhausted across every single time frame. If you buy here, you are walking into a trap. Okay, and you can see here the price goes down. The probability of the price goes down in this case will be much higher than 50% for sure. Okay, so let's look at another example. So this is a ServiceNow in April. The stock plugs. Retail traders are panicking, but look at the bias indicator on April 10th and 23rd. All three lines crash below their extreme negative thresholds. Okay. This is the maximum seller exhaustion. If you panic sell here, you are selling the absolute bottom right before the massive relief bounce. So do not sell on these 2 days. Okay, let's back to the lecture. And I have screenshot these two examples and copy and paste there in the lecture notes. All right. So during our afternoon golden window, the bias indicator is our ultimate veto filter. If you see a beautiful MACD golden cross, but the bias is stretched to an extreme, you walk away. We only execute when the rubber band is neutral. See you in the quant lab.